record adjusted EBITDA of $44 million up. What? These are not real numbers, right? But it is, because SoFi is an actual bank. Okay, SoFi is crushing it. Q3 report is out, Q3 2022, and the numbers, the top level numbers are amazing. The company is doing exactly what it's supposed to. As I keep saying, the majority is always wrong. We've seen SoFi stock crush this year. It's been dragged down. It tries to get back up, they drag it back down. They try to get it back up, it's dragged back down. Because there's so much fear and uncertainty and doubt in this market. There's so much misunderstanding about how these macro variables impact SoFi and banks. See, SoFi is a nationally chartered bank. That's a good thing, because as interest rates increase, the cost of getting a loan increases. And that means that the person giving you the loan makes more money, because every dollar you spend is a dollar somebody else makes. And in this case, you're the borrower, SoFi is the lender, SoFi is the one making the money. And if SoFi can make it as easy as possible for you to get a loan and for you to manage that loan and help you, of course, pay that down, right? Make it as easy as possible and give you a one-stop shop to manage all of your money while you pay down that loan, then SoFi will win your business even as interest rates increase and your loan becomes more expensive. And then as interest rates go back down, SoFi can still win, because they can then say, hey, refinance with us and you get all these other benefits and you get a lower interest rate with us. So SoFi wins on both sides of this coin. It's just that now they make a lot more money on the interest, which is a good thing. And people don't get that, because they say, oh, interest rates are increasing, the Federal Reserve is going to crush SoFi and all of the other stuff they say. But that's not the case. Banks do well in high interest rate environments, so long as they are managing the business well and that they aren't overly dependent on debt. So we see here that SoFi crushed all of their numbers. All the headline numbers. We have record GAAP and adjusted net revenues for third quarter of 2022. And they start with GAAP. That's the one that everyone loves to talk about, because that's the standard. So GAAP net revenue of $424 million. But that's a big number. But it's not the point. The point is, as a growth company, we want to see that number growing. We want to see it growing fast, because we're taking on high risk, because SoFi's still young. They're still losing money. And so what we get in return is high growth. And so if this number is not growing fast, then you're investing in a risky asset that also is not growing when it's supposed to be growing. And so you might as well be investing in a dividend stock or in mega cap big tech company that's not really growing that fast, because at least you get safety and maybe some dividends. So you want your growth stocks to be growing fast, 15%, 20% year over year, like that. Maybe 30% if they're very good. And so what do we have here for SoFi? Revenue growth of 56%. 56%. That's what we're paying for right there. That's what you pay for with a growth company like SoFi. All the risk you're taking, all of it, all of the ups and downs, the beating up by the market. We get up, they crush us back down. All of that is in the short term. If we can sustain growth like this for a couple more years before getting to profitability, and then continue growth similar to this, close to this, maybe 40%, 30% for 5-10 more years, we're going to be in a very good place. And that's why we look at these numbers, these top level numbers, and we see 56% net revenue growth year over year. And we say, cheers to us, SoFi. Cheers to us. And they go on, they say $419 million in adjusted net revenues, up 51%. So adjusted net revenues, that's the one that the newer companies like, because they say, hey, we're growing, we're trying to grow, so we're going to give you a number that more suits a bigger picture of what we're doing here, our bigger picture. It's not GAAP, but it gives you an idea of how fast we're growing and how well we're doing in departments that matter to a growth company. So we'll give you both the GAAP and our adjusted numbers, but even our GAAP is doing so well, while our adjusted net revenues are also doing well. We're at 51% year over year. So we're growing super fast in the standard numbers like CNBC and the Fox Business people love, which matter because that's the standard, that's the accounting practices that people respect, which is fair. So we give them that. We're growing super fast. They can't say we're not growing fast. And then we say to the investors who care about growth companies that, hey, look, our adjusted numbers, the ones that really matter to us, that we really benchmark, are also growing super fast. 51%. So we're at 56% GAAP growth in revenues and 51% for adjusted net revenue growth year over year. These numbers, I'm choking because these numbers are amazing. These numbers are just, they say record, and it's a record, right? So we go to the next line. Again, we're reading the headlines here. There's so much to cover in this report, in this Q3 report, and we're going to do more videos on it. So if you're interested in learning more about how SoFi did this quarter and the next quarter that's coming, and how this business is going to grow and continue to drive towards profitability, and what that means for investors, and of course, all the ups and downs along the way, you want to like and subscribe. Subscribe and hit the notification bell because we're going to be covering all of this going forward. And of course, comment. And if you're interested in where SoFi has come from, we've done documentaries. We are the channel. I know there's lots of hype channels out there on SoFi and other companies, but we actually do deep dives of these companies and documentaries to do the research. We've done a documentary, a 2-part documentary on the history of SoFi, how they actually almost completely failed because of their previous CEO, and then how Anthony Noto, our current CEO, came in and saved the company and turned it all around and made it what it is today. And we've discussed Galileo and how that's going to take SoFi all around the world, and how most of the fintech companies run through Galileo. We have so many videos on SoFi. We have the top video covering the initial investment memo from Chamath last year. Go watch those videos. The bank charter explaining how all of that plays into SoFi's growth and how it's actually playing out right now, because that's exactly what we expected. That's why the bank charter was such a big deal. And it's playing out so well. We can see it in these reports. It's amazing. We haven't gotten to the bank charter numbers yet, how the bank is doing. Just a little sneak peek. It's doing very well. It's doing exactly what we wanted it to do. So let's continue. But before we do, subscribe. Hit the subscribe button. Don't forget that. That's important. If you don't subscribe, I can't keep coming out here. That's really how this works. That's our relationship. So SoFi, Q3, record adjusted EBITDA of $44 million up. What? This has to be a joke, right? Whenever I read these numbers, I'm like, how is this possible? This cannot be another Enron, right? These numbers are so great that you question them. You think, am I being scammed? These are scammy numbers we're looking at here. Like, these are numbers that a scammer will give you. This can't be real. But it is, because SoFi is an actual bank. And if they screw up, they lie to us, they're in big trouble. With not only the SEC, but the Federal Reserve Bank and all of its regulators in this country. So as crazy as numbers look, as crazy as they look, I'm inclined to trust them, especially given Anthony Noto's history, his record. This is amazing. Wow. Let me read that again because I'm just struggling here. Okay. Excuse me. Record adjusted EBITDA of $44 million. Okay, that's cool. Up 332% year over year and up 118% sequentially. What? These are not real numbers, right? Oh man. 332% year over year. Of course, we got the GAAP. The GAAP looks great. Adjusted net revenues look great. Adjusted EBITDA, 332%. Wow. Okay, so how did they do that? How did they grow that fast in revenues? Well, they had new member ads of nearly 424,000. Members are great. That's just the top level. That's when they get you in their funnel and they send you their newsletters and they send you notifications and you have a chance at actually becoming a SoFi customer. So numbers are great. It's good to follow. Not the top number for me, but it's important. So they said they have a quarter end of total members up 61% year over year. And now it's at 4.7 million members. So again, that's up 61% year over year. That's great. Awesome. That's the top of the funnel. That's how we get the members in, and then we get them to try our financial services, and then we upsell them to lending products like personal loans and student loans and mortgages and cars and all the other stuff. So great to see members growing so fast. It's doing very well. 61%. Awesome. New product ads. This is what really matters. They had new product ads of 635,000. That's great. And at the end of the quarter, it was at 69% year over year, up to 7.2 million products. That's great. 69% growth in products. That's the products people actually use. So the lending products, the financial services products, and all the other products that they have, right? All these different products that they have are growing by 69% year over year in Q3 of 2022. And my mouth is just watering. God, these numbers are sweet. And of course, to top it all off, management raised guidance for the fiscal year of 2022, the full year, by some amount. It's not a big amount, but investors love to see it. So the guidance is raised. It's good, whatever, right? But there's just so much in here, like how deposits are up 83%. That's cash in the bank. That's the money people deposit with SoFi. That's what makes SoFi actual bank. They actually get to hold that money, then lend it out, and of course collect interest on it, and pay the interest, of course, to their customers, which they do at 2.5% right now. Tomorrow, today's Tuesday, so 2 days from now, there'll be increasing that to 3%. 3%. That will be 300 times more. 300 times more than JP Morgan, Wells Fargo, and all the others. All those traditional brick and mortar banks that screw you over with 0.01%. 1% of 1% is what they pay you. SoFi is going to pay you 3 whole percentages. 3%. 300 times more than them. That's how SoFi is growing so fast, because they're an actual bank now, and they get to control their interest rate. They get to control their relationship with their customers. They get to treat their customers better, because now that they're not paying some middleman on their profits, they get to keep all those profits. They can pass some of those profits to their customers in order to grow more customers, and then their customers love them and tell their friends about it. Tell their loved ones, their families about it. And they grow even faster. And then they use that again, all those profits, to increase interest rates so that they stay at the top, so that they can't be matched. And they keep growing until they get to maybe 100 million customers, depositors. And then they say, okay, we'll slow back it down a little bit. We'll let somebody else come up a little bit in 20 years, whatever the case, 10 years, 20 years, 30 years. And they just ride on all of that, all those deposits. And of course, they still have the one-stop shop that nobody else has, because it's very hard to build a one-stop shop financial app. And it's expensive. But the good news is that SoFi is vertically integrated. That's how it can do all of that. And of course, pass on those profits to their customers to make it all worthwhile and continue to grow. And so this is great. I'm loving these numbers. But of course, with greater growth comes greater expenses. And SoFi is increasing expenses, but of course their technology platform and their lending segments have net positive contribution profits. So that's good. Those segments are profitable. Where they're losing lots of money, like 50 some million dollars, I forget exactly what it is, but it's around that number, is in financial services. Financial services is still not profitable, probably won't be profitable for at least another year or a little bit longer. But SoFi still believes that they can become profitable by 2024 across the board, actually profitable. And so that will have to mean that financial services catches up, or at least cuts their expenses in half. But so far, their expenses continue to grow. And it's the only one that is actually losing money at the bottom line. Which is great news, because if SoFi decides that, hey, we are done growing, we don't want to grow as fast anymore, and we just want to do, instead of 50% growth, we want to do 20%. Then they can slow down financial services, and that becomes contribution profitable, which means all of their segments are contribution profitable. And then all they have to do is cut down on marketing, which will bring down their expenses, and cut down on their whatever other, which is, I guess, the employees, cut down on hiring or whatever the case there, maybe even do layoffs. These are worst case when it comes to deciding, okay, we want to just grow now. Again, SoFi is a growth company. They're not going to do that. I'm just saying, if they wanted to, they could be profitable pretty much tomorrow by just cutting these expenses. So I'm not too worried about the growth in those expenses on financial services, because that's how they grow. To grow, you have to pay for that growth. And so again, SoFi does it by bringing in customers at the top of the funnel, which is the financial services, and then funneling them down to lending products, and of course deposits and all that other stuff. And they make a bunch of money at the bottom line. Of course, through Galileo as well, because Galileo, the other banks, other fintechs out there who make money, they pay Galileo, which is owned by SoFi. And that's profitable, and that's growing very fast. So lending is growing fast, and Galileo is growing fast, which is great, which is all great. But again, I want to end it by saying this: it's not all peaches, right? There are losses here because of expenses on their financial services. So this is all great. And of course, I buried the lead. They beat expected earnings per share, EPS, by 1 cent. So the market was expecting negative 10 cents in earnings per share. They had negative 9 cents in earnings per share, EPS. Great. And that's 5 straight quarters that we can see here of them beating expectations. It's great. It's all good. I'm loving it. The stock is up 14%. It was up about 19-20% this morning before the market opened. There's a lot more to cover here. If you're interested in more of this report, this Q3 report, definitely subscribe. Hit the like button, hit the notification bell so you don't miss our next videos, and comment your thoughts on SoFi. Are you investing? Are you still investing? Are you selling? Are you holding? What are your thoughts on all of this? What would you like me to cover next? Let's get into it. Hope you enjoyed this. I'm Lincoln with BoyAcademy.org. Thank you again, and have a great day.